future of cryptocurrency, regulation, innovation, and global adoption. Hello everyone, and welcome back to the channel. Today we are diving into one of the most important topics in the cryptocurrency world, the future of crypto, the role of regulation, and how blockchain technology could transform finance over the coming years. Whether you're a Bitcoin holder, an Ethereum enthusiast, or simply curious about digital assets, this is a conversation that affects everyone involved in the crypto space. So let's get started. Cryptocurrency has experienced one of the most remarkable growth stories in modern financial history. When Bitcoin was introduced in 2009, very few people paid attention. Most investors, governments, and financial institutions viewed it as an experiment. Fast forward to today, and the crypto industry has grown into a global market involving millions of investors, thousands of companies, and some of the world's largest financial institutions. Bitcoin has become a household name. Ethereum has created an entirely new ecosystem of decentralized applications. And blockchain technology is now being explored by banks, governments, and major corporations around the world. But despite all this progress, one question remains. What happens next? Many experts believe the next phase of crypto growth will be determined by four major factors: regulation, technology, institutional adoption, and real-world utility. Let's begin with regulation. For years, crypto companies have operated in an environment filled with uncertainty. Different countries have taken different approaches. Some governments have embraced digital assets, others have imposed strict restrictions, and many are still trying to determine how cryptocurrencies should fit into existing financial systems. This uncertainty creates challenges. Companies want to know which rules apply to their products. Investors want protection from fraud and scams. And regulators want to ensure financial stability while encouraging innovation. Supporters of clear crypto regulations argue that better rules could actually help the industry grow. When businesses understand the legal framework, they can invest more confidently. When institutions understand compliance requirements, they can offer more products. And when investors feel protected, they may be more willing to participate. However, many blockchain supporters worry about excessive regulation. They argue that innovation often moves faster than government policy. If regulations become too restrictive, startups may struggle to compete, and innovation could slow down. The challenge is finding the right balance. Governments must protect consumers without preventing technological progress. This balancing act will likely remain one of the most important issues in crypto over the coming years. Now let's talk about institutional adoption. A decade ago, most large financial institutions avoided cryptocurrency. Many executives publicly criticized Bitcoin. Some claimed it would never survive. Others dismissed it as speculation. But over time, attitudes began to change. As blockchain technology matured and investor interest increased, institutions started paying attention. Today, many major investment firms offer crypto-related products. Asset managers are exploring digital assets. Payment companies are integrating blockchain technology. And banks are investing in research and development. Institutional adoption matters because large organizations bring capital, infrastructure, and credibility. Their participation can attract additional investors and accelerate mainstream acceptance. But institutions are not entering the market simply because crypto is popular. They see potential benefits. Blockchain technology can improve transparency. It can reduce settlement times. It can lower costs. And it can create entirely new business opportunities. This brings us to technology. At its core, cryptocurrency is powered by blockchain. A blockchain is essentially a distributed ledger that records transactions across a network of computers. Because records are shared across multiple participants, altering past transactions becomes extremely difficult. This creates transparency and security. Bitcoin introduced the concept of decentralized digital money. Ethereum expanded the idea by introducing smart contracts. Smart contracts are programs that automatically execute when certain conditions are met. This innovation opened the door to countless applications. Developers could now build financial products, games, marketplaces, and digital ownership systems directly on blockchain networks. As a result, blockchain technology evolved far beyond simple payments. One of the most important developments resulting from smart contracts is decentralized finance, commonly known as DeFi. DeFi aims to recreate traditional financial services without relying on banks or centralized intermediaries. Users can lend assets, borrow funds, trade tokens, and earn yields, all through decentralized protocols. Supporters believe DeFi could make financial services more accessible to people around the world. Traditional banking systems often exclude millions of individuals. Some people lack access to financial institutions. Others face high fees. Blockchain-based financial services may help reduce these barriers. Of course, challenges remain. Security risks exist. Smart contracts can contain vulnerabilities, and users must understand how these systems work before participating. Nevertheless, DeFi remains one of the most innovative sectors within the crypto industry. Another major trend is tokenization. Tokenization involves representing real-world assets on blockchain networks. Imagine owning a small fraction of a building, a piece of valuable artwork, or shares in an investment fund, all represented digitally on a blockchain. Supporters argue that tokenization could improve liquidity and reduce transaction costs. It may also create new investment opportunities for people who previously lacked access to certain markets. Many experts believe tokenization could become one of blockchain's most impactful use cases. Now let's discuss Bitcoin specifically. Bitcoin remains the largest cryptocurrency by market capitalization. Its supporters often describe it as digital gold. One reason is scarcity. Bitcoin's supply is capped at 21 million coins. Unlike traditional currencies, which can be printed by central banks, Bitcoin follows a predetermined issuance schedule. Supporters believe this scarcity gives Bitcoin unique characteristics as a store of value. Critics, however, point to volatility. Bitcoin's price has experienced dramatic swings throughout its history. Investors should understand that volatility remains one of the defining features of cryptocurrency markets. Ethereum represents another important piece of the puzzle. While Bitcoin focuses primarily on value transfer and scarcity, Ethereum serves as a platform for decentralized applications. Thousands of developers build products on Ethereum. Its ecosystem includes DeFi applications, blockchain games, marketplaces, and digital ownership systems. Competition among blockchain networks is also increasing. Projects are constantly working to improve scalability, efficiency, and user experience. Some networks focus on speed, others focus on security, and many attempt to balance both. This competition drives innovation and encourages continuous improvement throughout the industry. Now let's examine one of the biggest concerns among investors: risk. Every investment carries risk. Cryptocurrency is no exception. In fact, crypto markets are often more volatile than traditional markets. Prices can rise rapidly during periods of optimism. They can also fall sharply during periods of uncertainty. For this reason, risk management is essential. Experienced investors often avoid making decisions based solely on emotions. Instead, they focus on research, planning, and long-term goals. Diversification is another important concept. Many investors choose not to place all their capital into a single asset. Instead, they spread risk across multiple investments. Education remains one of the most valuable tools available to investors. Understanding blockchain technology, market cycles, security practices, and investment principles can help individuals make more informed decisions. Speaking of security, cybersecurity remains a critical topic. As the value of digital assets increases, cybercriminals continue searching for opportunities. Investors must protect their accounts, wallets, and private keys. Using strong passwords, enabling two-factor authentication, and understanding common scams can significantly improve security. Another exciting development involves the intersection of blockchain and artificial intelligence. AI technologies are advancing rapidly. Some companies are exploring ways to combine AI with blockchain systems. Potential applications include automated analysis, enhanced security monitoring, decentralized data marketplaces, and improved efficiency. While this area remains relatively new, many experts believe it could become increasingly important in the future. Environmental concerns have also become part of the crypto conversation. Some blockchain networks require significant energy consumption. As a result, developers have worked on creating more energy-efficient systems. New technologies and alternative consensus mechanisms continue emerging to address sustainability concerns, the industry's ability to balance innovation with environmental responsibility may influence future adoption. Now let's consider global adoption. Cryptocurrency is no longer limited to a handful of countries. Interest exists across the world. Developed economies are exploring digital asset regulations. Emerging markets are investigating blockchain-based financial solutions. Businesses are experimenting with tokenized assets. And consumers are becoming increasingly familiar with digital ownership. However, adoption does not happen overnight. Major technological shifts often take years or even decades to reach their full potential. The internet itself required many years before becoming an essential part of daily life. Blockchain technology may follow a similar path. Progress is occurring, but widespread adoption takes time. Looking ahead, the future of crypto will likely be shaped by several key questions. Can regulators create clear and balanced frameworks? Can blockchain networks continue improving scalability and usability? Can institutions integrate digital assets into traditional finance? Can developers create applications that solve real-world problems? And can investors navigate the risks while participating responsibly? The answers to these questions will influence the industry's next chapter. Some analysts believe cryptocurrency could become a fundamental component of the global financial system. Others remain cautious and expect slower adoption. Regardless of which perspective proves correct, blockchain technology has already changed the conversation surrounding money, ownership, and digital transactions. Its influence can be seen across finance, technology, and business. The journey is far from over. Innovation continues. New applications are emerging, and the global discussion around cryptocurrency remains as active as ever. For investors, developers, and enthusiasts, the coming years may represent one of the most important periods in the history of digital assets. Whether you're bullish or bearish, one thing is clear. Cryptocurrency and blockchain technology are likely to remain major topics for years to come. What do you think about the future of crypto? Will regulation accelerate growth? Will blockchain transform global finance? Or do you believe adoption will take longer than many expect? Share your thoughts in the comments below. If you enjoyed this video, don't forget to like, subscribe, and turn on notifications for more cryptocurrency content. Thank you for watching, and I'll see you in the next video.